You know how everyone always says the stock market's like a roller coaster? Well, lately it's felt more like one of those old rickety wooden ones. You know, the kind that just throws you around.
Yeah, I know exactly what you mean.
It can be tough to keep your head on straight, with all the financial news flying around these days. What should we even be paying attention to?
Well, that's what we're here for today.
Exactly. For this deep dive, we're going to be using this recent article from the Smart Investor as our guide.
Great article.
It breaks down all this current market volatility with insights from, well, some pretty big names in finance. We've got Tom Lee, Eric Sheridan, and Ed Yardeni. We'll unpack their views, and more importantly, by the end, you'll walk away with some strategies that you can actually use, not just to survive, but maybe even come out ahead.
It's not just about knowing what's happening, right? It's about knowing what to do with that information.
Exactly. So let's kick things off with Tom Lee. Now, he's always been kind of known for going against the grain, and even with all these recent dips, he's actually pretty bullish.
Oh, yeah?
One of his big arguments is that there's all this cash, tons of it, just sitting on the sidelines.
Right.
You'd think that would be a red flag, right?
You would think.
But Lee doesn't see it that way at all.
Interesting. So what's his take?
Well, he's saying it's not just about the amount of cash, it's where it's being held. Apparently, money market funds are overflowing. We're talking trillions of dollars here. But active fund managers are actually holding less cash than usual.
Oh, so it's like a tale of two cash piles.
Yeah, I guess you could say that.
So if institutions are still invested, does that mean it's more the average investor who's spooked?
That seems to be Lee's point.
Makes sense. When the headlines are screaming doom and gloom, it's easy to get caught up in the fear.
Yeah, and Lee actually uses some specific indicators to back up his view. Things like the AAI Investor Sentiment Survey. It's showing a lot of pessimism right now. And there's also the CNN Fear and Greed Index. That one's pointing towards fear, too. He argues that these readings, historically, they've often been a good sign, kind of a signal that it's a good time to buy.
Like a contrarian indicator, almost.
Yeah, exactly. He's pointing to times like, 2016 and 2018 when there was a lot of bearish sentiment, but then the market rallied pretty significantly.
So those times when everyone else is running for the hills, that's when Tom Lee starts looking for bargains.
It seems that way.
It's an interesting approach, for sure. I mean, no indicator is perfect, but looking at sentiment can sometimes give you a different perspective.
Right. And to be fair, he does say you have to look at these indicators along with other factors.
Of course, yeah. You can't just blindly follow one indicator. Got to look at the whole picture.
Exactly. But, one of the things I find really interesting about Lee is how he emphasizes that these corrections, the dips we're seeing, they're totally normal.
Yeah, I mean, the market doesn't just go straight up, right?
He points out that the S&P 500, get this, it's had a 10% or greater drop in 85% of the years since 1950.
Wow, 85%. That's pretty consistent.
It's almost like clockwork,
And yet, despite all those dips, I'll zoom out and look at the long-term trend. Still going up.
Right? It's wild. So maybe instead of getting scared when things drop, we should see it as, I don't know, a chance to get a discount.
Exactly. I mean, if you're a long-term investor, these dips can be opportunities, not something to panic about.
Okay, so we've got Lee focused on market sentiment, but let's shift gears and hear what Eric Sheridan from Goldman Sachs has to say. He's got some really interesting thoughts on this whole AI trade.
Oh, yeah. Everyone's talking about NVIDIA, right?
Yeah, but Sheridan's point is that it's bigger than just NVIDIA. It's not just about the chip makers.
So he's saying there's more to the AI story than just the hardware.
Exactly. He sees the whole AI thing kind of evolving, going beyond just the infrastructure phase.
So what's the next phase then?
Well, he thinks the real opportunity is going to be with companies that are using AI to, enhance their existing products and services. Not just building the AI tools, but actually putting them to work.
Interesting. So instead of just focusing on the companies making the picks and shovels, he's saying we should be looking at the companies digging for gold.
Yeah, exactly. We should be looking at how companies like Meta and Microsoft are using AI to actually do stuff, not just who's making the chips.
It's a good point. The companies building the initial infrastructure, they're important, but their growth might slow down as that initial investment wave kind of fades.
Right.
But the companies that figure out how to really leverage AI, how to bake it into everything they do, those are the ones that could really take off.
That's what Sheridan seems to think.
And I mean, it makes sense, right? It's like anyone can buy a hammer, but it takes skill to build a house.
Great analogy. Okay, so it's not just about riding the hype wave. It's about finding companies that are actually using AI to create value. Now, what's interesting is Sheridan also seems to be pretty bullish on companies like Apple and Alphabet.
Really? Even though their stocks haven't been doing so hot lately?
Yeah, even though they've had some dips.
What's his reasoning there?
Well, his point is that both Apple and Alphabet have the resources, like the huge scale, to really be major players in AI. I mean, they're already integrating AI into their products and services, everything from Siri and Google Assistant to all their recommendation algorithms. Sheridan thinks that over time, all these AI initiatives, they're going to start translating into more revenue growth and help them solidify their position in the market.
So he's betting on their long-term potential in AI.
That seems to be the gist of it.
But even with these giants, it's still all about diversification, right? You wouldn't put all your eggs in one basket, even if it was full of AI-powered gadgets.
Absolutely. Spread the risk, right?
Exactly. Look for companies with a solid plan for making money from AI.
And a good track record of innovation. Don't just chase the hype.
Right. Make sure the valuations make sense, given their growth potential.
All solid advice. Okay, so we've got Lee focused on market sentiment, Sheridan looking at the evolving AI landscape, and now let's turn to Ed Yardeni. He seems to be all about cutting through the noise and focusing on the fundamentals. And he's really not buying into all this recession fear that's been going around.
He's not.
Nope.
So what's he seeing that everyone else seems to be missing?
Well, he's pointing to the data. He says retail sales are strong, up 5% year over year, and unemployment claims are still near historic lows. That's a pretty good sign that consumers are still spending.
That does suggest a healthy economy, but what about all the talk about consumer sentiment being down? Isn't that a contradiction?
It does seem like it, right? But Yardeni argues that those consumer sentiment surveys, they can be easily swayed by, political stuff and what the media is saying. He doesn't think they always reflect what people are actually doing.
So he's saying, don't just listen to what people say they're going to do. Look at what they're actually doing.
That's Yardeni in a nutshell.
Makes sense. Actions speak louder than words, right?
Exactly. He's also not too worried about things like tariffs and immigration policies.
Really?
He doesn't see them as big long-term threats to corporate profits.
Huh. Why is he so dismissive of those concerns? I mean, they seem pretty significant.
Well, he believes that any negative impact from those macroeconomic factors is likely going to be offset by, that AI-driven productivity boom that everyone's talking about.
So he's basically betting on technology to power through any potential headwinds.
Yeah, he sees technology as this, unstoppable force that'll just keep driving growth and efficiency, even if there are bumps along the way.
It's an optimistic view, that's for sure, but I can see where he's coming from. We've seen technology disrupt and transform so many industries already.
Absolutely. But what about valuations? I mean, things seem pretty pricey right now, don't they? The S&P 500's forward PE ratio is pretty high.
True, valuations are definitely elevated, but Yardeni says it's justified because, well, he expects strong earnings growth. He's not saying the market's cheap, but he thinks the current prices reflect the positive outlook for corporate profits.
So we've heard from Lee, Sheridan, and Yardeni, and they all seem, cautiously optimistic, despite all the volatility.
Yeah, cautiously optimistic. That seems to be the theme.
But what does it all mean for us, the average investors? That's what we're going to tackle next. How can we use all these insights to actually make decisions about our own portfolios?
That's the million-dollar question, or maybe the trillion-dollar question, given how much money is at stake in the market.
Exactly. So stay tuned. We'll be right back after the break. Okay, so we've heard from the experts, but how do we actually use all this information? What does it mean for our own portfolios? That's where this Smart Investor article comes in. They have some really practical advice, especially for a volatile market like we're in now.
Yeah, I was really impressed with their strategies.
Me too. They talk about 4 main things: ignoring the noise, prioritizing quality, dollar cost averaging, and focusing on earnings.
Solid advice. It's easy to get caught up in the headlines, but those are the things that really matter in the long run.
Okay, so let's break those down one by one. Ignoring the noise. I mean, that sounds simple enough, but how do we actually do it?
Yeah, it's easier said than done when your portfolio is bouncing up and down every other day.
Right. How do you just tune out all that chatter and just focus on what matters?
Well, it's about recognizing that a lot of that noise, like all those market predictions and expert opinions, it's all designed to keep you glued to the screen and kind of reacting emotionally.
So they're playing on our fear and greed.
Exactly. But remember, we're long-term investors, not day traders. Our focus should be on those underlying businesses, not on those daily ups and downs.
So it's about looking past the headlines and focusing on the fundamentals, like tuning out all that political noise, the drama of those market swings, and just remembering our long-term goals.
Exactly. Don't get swept up in the short-term frenzy. Instead of panicking when things drop, use those moments to reevaluate your portfolio and maybe even find some bargains.
So a disciplined investor uses a downturn to their advantage.
Precisely. Remember, we're in this for the long haul, not just for a quick buck. It's a marathon, not a sprint.
Love that analogy. Okay, so we ignore the noise. Next up is prioritizing quality. I mean, we all want to own good companies, right? But how do we actually find them? There are so many archons out there.
Especially when things are uncertain, you want to look for companies that have a solid track record, right?
Yes, stability and growth.
Exactly. Think of those big tech companies we were talking about earlier, Apple, Microsoft, Alphabet. They might not be the hottest new thing, but they've got those strong balance sheets, consistent cash flows, and they've been through a lot. They know how to weather a storm.
They're kind of like the blue chip stocks of the tech world. Maybe not as exciting as some of those startups, but they're the ones you want to hold on to when things get tough.
That's a great way to put it. They offer stability and resilience, which can be really valuable when the market's feeling shaky. And don't underestimate their ability to adapt and innovate. They have the resources and the talent to stay on top.
Makes sense. So we ignore the noise, we prioritize quality. What's next?
Dollar cost averaging.
Oh yeah, that's a classic. Remind me how that works again?
So instead of trying to time the market, which is, let's face it, almost impossible.
Yeah, good luck with that.
Right. With dollar cost averaging, you just invest a fixed amount of money at regular intervals.
So it's like, instead of trying to buy low and sell high, which never really works out the way you want it to,
Yeah, we've all been there.
you're just consistently investing bit by bit.
Exactly. The beauty of it is it takes the emotion out of it. You're not panicking when the market dips because you're already committed to investing that amount. And over time, you actually end up lowering your average purchase price because you're buying more shares when prices are low.
So you're kind of taking advantage of the dips without having to predict them. Plus, it just feels more manageable. You're not putting all your eggs in one basket at one specific time. I definitely see the appeal of that. Okay, and last but not least, we need to focus on earnings, not headlines. Why is that so important?
Well, remember what Ed Yardeni said. Earnings are what ultimately drive value. A company can have a great story, a charismatic CEO, and tons of media buzz, but if it's not making money, it's not a sustainable investment.
So don't be fooled by all the hype. Look beyond the headlines and see if those companies are actually walking the walk. Are they actually making money?
Exactly. And a great way to check on that is coming up soon with those first quarter earnings reports.
That's right. We'll get to see how those companies are actually performing, especially those AI companies everyone's talking about.
I know. It's going to be really interesting to see how the AI boon is actually impacting their bottom line.
NVIDIA's report is coming out on the 21st, right? That's going to be a big one.
Yeah, everyone will be watching that one closely, but on just NVIDIA, keep an eye on the earnings of any companies you're invested in or thinking about investing in. Look for companies with strong revenue growth, good profit margins, and a clear strategy for navigating the current economic conditions.
It's so easy to get caught up in the excitement, but ultimately it all boils down to those fundamentals. Are these companies making money? Are they growing? Are they well managed? Those are the questions that really matter.
Couldn't agree more. If you can learn to filter out all that noise and focus on the things that actually drive value, you'll be in much better shape to handle whatever the market throws at you.
So to recap our 4 key strategies: ignore the noise, prioritize quality, dollar cost average, and focus on earnings, not headlines. I mean, they sound pretty straightforward, right? But it's amazing how easy it is to forget those things when the market gets crazy.
It really is. It's all about staying disciplined and sticking to your plan even when things feel uncertain. These are time-tested strategies that have helped investors for decades.
Like having a roadmap for navigating a storm.
Exactly. It helps you stay on course and reach your destination.
That's a perfect analogy. Okay, so we've covered a lot of ground today, from understanding market sentiment and the AI landscape to these actionable strategies. What a deep dive.
It really has been a deep dive, but hopefully a valuable one.
I think so. I mean, one of the big takeaways for me is that volatility is inevitable. It's just part of the game.
It's the price of admission to the stock market, right? Like we were saying earlier. But it doesn't have to be something to fear. If we approach it with the right mindset and those solid strategies, it can actually create opportunities.
Totally. So instead of panicking, we should be looking for those chances to buy into great companies at a discount.
Exactly. And here's a final thought to chew on. While we've talked about some of those short-term risks, don't forget about the long-term potential of all this innovation that's happening. AI, robotics, decarbonization, these are huge trends that are going to keep driving progress and creating opportunities for investors.
It's like you said earlier, don't let the short-term noise drive out that long-term signal.
Right, those underlying trends are still driving us forward. So instead of seeing volatility as a threat, think of it as a chance to buy into those innovations at a lower price. As always, do your research, be smart about your investments, and stay focused on your long-term goals.
Couldn't have said it better myself. That's a wrap on this deep dive into market volatility.
We hope you enjoyed it.
We hope you found it helpful and you're leaving with more confidence and a clearer understanding of how to navigate this crazy market.
Because even in turbulent times, there are always opportunities out there. You just have to know where you look.
That's right. And until next time, happy investing, everyone. It feels like we've been talking forever. We've covered so much: sentiment, AI, and now these strategies. My brain's full.
It's a lot to take in, that's for sure. But it's all connected, really. I mean, the big thing to remember is that volatility, it's just inevitable. It's just part of how the market works.
So it's kind of like a cover charge, to get into the club of wealth creation.
Yeah, exactly. And just like any good club, there are going to be ups and downs, moments of excitement, moments of doubt. But the main thing is to remember why you joined in the first place.
Right. You're in it for the long haul, not just there for a one-night thing. These strategies, they help you kind of like stay focused on the bigger picture, right? Even when things get a little crazy.
That's the whole point. If you look back, history's shown us over and over that those who write it out, who just focus on the fundamentals and stick to their plan, they're the ones who ultimately come out ahead.
So maybe instead of being scared of volatility, we should see it as, I don't know, maybe like an opportunity.
Exactly. If you can approach it with the right mindset, the right strategies, it can definitely present some unique chances.
So buy low, sell high, right? Isn't that what they always say?
Well, it's not always quite that simple, but the idea is sound. When others are panicking, that might be your moment to, find some good deals. Buy into some solid companies at a bit of a discount.
Now, that makes sense. So don't let the fear take over, right? Think long term.
Exactly. And here's one more thing to think about while we've talked about some of the risks and the unknowns in the short term. Don't forget about the power of innovation in the long term. Things like AR, robotics, this whole push towards sustainability, decarbonization, those trends, those are powerful
Right,
forces.
the world's not standing still.
Exactly. And all those advancements are creating tons of opportunities for
Like
investors.
you said earlier, tune out the noise and focus on the long-term signal.
You got it. Don't let those short-term swings distract you from the bigger picture. Those underlying trends, they're going to keep driving progress, and those are the things that ultimately matter most. So instead of fearing volatility, think of it as a chance to maybe get in on the ground floor of some really exciting innovations. And of course, always do your research, be smart with your money, and stay focused on your goals.
I love that. Such a great reminder. Well, that will wrap things up for this deep dive into market volatility.
I hope you enjoyed it.
We hope you found it valuable and that you're leaving here feeling a little more confident, maybe a little clearer on how to handle all the craziness out there in the market.
Because even when things feel shaky, there are always opportunities out there. You just have to know where to look and how to react.
Couldn't have said it better myself. So until next time, everyone stay informed, stay curious, and happy investing.